All right, we've got just under a minute to go before we get this week's trade idea stream kicked off. If you are sitting there patiently watching while we wait for this thing to get going, feel free to check in the chat so I can know you're there. All right, there we go. We got Dashio. He's ready to go. We got Jules talking about Tesla earnings. We got More4. Shout out to More4. JP in the YouTube chat. I love to see it. I love to see it. We got a good crew on tonight. We got 4 more seconds until we get going. I'm just going to X out of it so I don't even get the notification that I have to X out of. Oh, there it is anyways. All right. We've got Rodrigo in the YouTube chat who's still holding 400 shares of BBIG. We'll definitely talk about that one. Talk about that one tonight. Cliffo in the Twitch chat. How's it going, everyone? Glad you guys can join us again for another week, and we're just gonna get right into it. I'm not gonna have some terribly boring monologue at the top of this one, but we're gonna start with the recap and then get into what we're looking at for the upcoming week. And last week was definitely an interesting one for us because, I guess before we get into this, we made money, so that is always a good thing. However, if you scroll down a little bit, we did slightly underperform the S&P 500 index, which, you're splitting hairs a little bit. We definitely do want to outperform the S&P 500 index, but at the same time, I'm never going to complain during a week when we make money. And most importantly, us making money last week put us into the green overall in July. And we love having the ability to say, hey, guess what? We haven't lost money in a single month this year yet. So this next upcoming week that we got is going to be the last week of July. So if we could close out in the green, that is going to be huge for us. So we've got a lot to look forward to. With that said, though, how did we get to where we ended up? And you'll notice that our list of positions that we were in, if you've been following along with us, is a lot longer than what we typically see on a week-to-week basis. And quite frankly, that's just because I had a little bit of free time on my hands last week, so I was able to be a little bit more active getting in and getting out of positions. What we like to say so often with the strategies that we have is that you could be as active or as inactive as you'd like. You could take some of these safer plays that you have that we've been sitting on for a couple weeks or months at a time and just let those go to work for you. Or you could jump in on some of the things that we opened up earlier this week where I know we categorized it as premium chasing, but we were able to get in and out of those and scalp a decent bit, a couple $100 of profit at a time. So those worked out really nice for us. But again, you don't need to be glued to a trading screen. If you do want to be glued to a trading screen one day and be more active, that's definitely something you could do with our strategy. But at the same time, if you don't want to be hunched over a computer staring at charts all day waiting for entries and exits, that's something you can do too. We love the flexibility. But taking it from the top, UWMC made a tiny bit on that. We got some decay on the 7.5 puts for December and the 7.5 for August 20th. We're looking good to go right there. It looks like if we pull this up, UWMC finished up at 766, so we know that we're in max profit territory for both those. If it stays where it is, we are going to make an additional, well, we made 250 off it last week. We've got an additional $6,500 coming in, just as long as UWMC that you see right there stays above 750, headed towards the back end of this year. So we're super happy with that one. ICLN, we say this every single week. It is such a boring play. I'm not even going to talk about it. But that one made us a little bit of money because the stock jumped up a tiny bit. Corsair, this is one where we were objectively green. It did get up to about 6.7. We could pull the chart up really quickly and take a look at it. Yeah, Corsair got up to almost $31 on Wednesday morning. So we were looking a lot better halfway through the week on that one than we were ultimately. But again, it started the week off at 29.33, finished up at 29.52. I'm not going to complain about making a few $100 off the shares right there. We know that we sold the 32.5 strike call, so if it does rebound, and if we take a look at this in the context of the last trading month, if this rebounds up to just the 32.5 level, which if we back up even further, is relatively low in the scheme of things, but if it gets back up to that level, we're going to be able to have our shares called away for 32.5, which is going to be another $4,000 for us, in addition to that $1,500 of option premium that we're going to be able to collect. So similarly to UWMC, we've got about $6,000 of profit we could potentially collect on Corsair in the coming weeks. And we can take a look at how that trade breakout is looking. We are down overall, But, important to note, we started this trade off and it was trading at 38.5, and we now have our break even price all the way down to $30.37, which is a 21.12% reduction in break even price just over the course of a month. And they do have earnings coming up in a couple weeks, so that's something that we're going to want to keep our eyes on. But as it stands right now, sucks to be down, be losing 5.6%. But, it's trading at 29.52. If they have good earnings, it shoots back up to 31 or something like that. We're right back in the green. And it's like these losses never happen. So we're not too worried about that. Back to the weekly tracker going down the list. Open Door is one that we got in and out of really quickly. We got into the 12.5 strike puts. We could pull the chart up on that one as well because I think it's a good one to look at. Ooh, nice spelling right there by myself. Open Door, as you could see, let me go back to the 20-day right here. It dropped down a little bit at the beginning of the week. That was when we had that big red week in the S&P 500 into the overall market, and we thought, okay, people are starting to panic a little bit, and then it shot back up like nothing ever happened. But we were able to enter right there for 60-cent credit. If we look at the option chain right now, let's bump this down to 14 options. It is right about where we exited, so nothing too attractive from a re-entry perspective, even though it has pulled back a little bit over the last couple days. The 14s don't look too terrible if we take a look at the return on risk, which is the best way for us to evaluate the profitability of these trades. You've got about 7.28%, which, these things expire August 20th. We've got 1, 2, 3, 4 more weeks until then, so I really don't want to get into some of these monthly options until we're in that 2 or 3 week window. So we'll take another look come next Monday and see if this is something that we potentially want to enter back in on. But, I like the stock. I like the entry point that we have right here if we back it up. Definitely a pretty big discount from where it's been trading historically on the back end of 2020 and the front end of 2021. But with that said, it's one of those stocks that we have our eyes on. It's on our watch list that we have in Excel format. So we knew that when it dropped down to that 13, the high 13, low 14 level was something we wanted to take advantage of, and we were able to execute that trade pretty well. Delta Airlines, same deal, solid stock. We had it on our watch list. Anything below 40 we thought was kind of a steal, and as you could see from the immediate green candle once this thing dipped below 40, that held true. We entered right around here, spiked right back up, and we sold let's see, what was it? 36 strike puts, right? So even though things did look pretty bad on Monday, it never even got within sniffing distance of that price level, which is going to be our max profit level at 36. So that one was pretty much a walk in the park, and we were still able to pull about a couple $100 off of that one. So perfectly happy with the way that turned out. And that gets down to SPX, which, we say these are our hedges on a week-to-week basis. But if you take a look at, we'll look at SPY because that's going to be the easier chart to look at. These are basically the same thing. Big drop off on Monday, right? Maybe could have figured that something like that was coming since the market started selling off a little bit. But on Monday, we got to a pretty low point overall in the market. And at that point, we said, we love to look at RSI, right, as an indicator, relative strength index. That RSI chart getting down into the blue is something that indicates, okay, this is oversold and it's primed for a jump. So when we did notice that it dropped, RSI was in the blue. We jumped in on some bullish put credit spreads, which we sold for 85 cents at roughly a 421 short leg, meaning as long as it finished above here relatively, we were going to be okay. And as you can see from the rapid recovery on the back end of last week, these never even got threatened. And those were Wednesday expiries as well. So this is the day of expiry on those that we're looking at. But long story short, we were able to look at RSI, play the bounce. And that wasn't a hedge. This was just something that we noticed because we like to watch SPX a lot. And that was something we were able to capitalize off of. But as you could tell, we had a little bit bigger of an issue with our hedges where we lost about $1,400 last week. And that cut decently into our profit. And it's tough because, when SPY starts running up, it makes it harder to maintain consistent performance with the market because that's a level we're trying to get to. We're trying to get to that 1.95% return. But as this increases and gets to a level that's harder for us to get to, our losses on the hedges also start to increase as well. So that's where you see that we walked away with roughly that $1,400 loss. But at the same time, we took a look at the chart. You see there's this big gap down and it got filled very quickly. This was about the point we had our eye on and said, hey, It filled the gap a little bit too quickly almost. We think there's going to be a little bit of relief, so we went in a little bit heavier on the spreads. That came back to bite us a little bit, but what's important to note here is that we were able to get out of both of these and roll them a day or two early for less than $2, $2 for the spread. If we had let these run up to hit max loss, which they would have by the end of the week, this would have been worth 5. This would have been worth 5, and we would have had some serious losses on our hand. So while those SPX hedges did kind of bite us in the ass a little bit, what we did well was stick to our plan of rolling these, a day or two in advance if it starts to test the short leg that we have on those. So instead of like we saw where we could have potentially lost about $6,000 if we had held steady with those, we only took a $1,400 loss. And in the context of everything that we've got going on with our overall portfolio, a $1,400 loss is very easily absorbed. So we never like to lose $1,400, but it's going to be okay because of everything else we've got going on. That's why position sizing is so important, and rolling these and making sure we don't take anything near that max loss is also so important. Jumping ahead a bit here, we did roll a slightly larger hedge into next week because you could see RSI is getting jacked up a little bit again. If we back up to the 180 day, it's starting to get into this overbought territory, and that was before the little red candles you see right there. And then we've got the S&P 500 futures up here on our watch list. If every time we come back to Thinkorswim, you're trying to keep an eye on that, they're right here, and they're down about 0.32%. So I think we're looking good with that regard for our larger SPX hedge that we have headed into next week. But back to the recap of last week, IPOF, that one's been sitting there. We've got the same plan with that. There's, at least at the time, there was very little extrinsic value on the options. This thing's a SPAC. If it pops back up above 1040 at some point, which is just a 4% gain on that stock at any point between now and September, we're going to make some profit on that. So perfectly happy with where we are. I don't want to double down or anything like that. The thesis is staying the same. We're going to keep that IPOF position exactly how it is, and just let it sit in the bottom of our portfolio if something crazy happens with IPOF, which if you take a look at the chart historically, and I spelled another ticker incorrectly, every now and then you'll see some sort of a pop. I mean, there hasn't been a ton of activity in the last few months, which is why that premium on the call is so low, and that's why we thought it was a decent option buying activity, or opportunity rather. But historically, it has this kind of potential to run. So if we see any sort of decent run back up to these levels, and I think this red line here represents our break-even price on this individual long option trade that we have. So if it gets back up around here, I mean, we've got 2 months to wait. I'm not terribly worried about this. We're just going to let that one sit. BBIG, we got pretty conservative when we rolled the call strike. If we jump over to our trade breakout tab that we have for BBIG, you'll see we started playing this one at 379 back on 30th. And since then, it's dropped 14.78% on us, which, never ideal. However, the thing we really want to draw attention to is what we were able to do with our break-even price, because, stocks can drop on us whenever. They'll rebound, they'll go up, they go down. But what we can consistently do from our end with our option selling strategies is continue to lower our break-even price week after week after week. So as you can see, we started when the stock was at 379. Our initial play gave us a break-even price of 344. And then what we did was we got into the second part of the HT wheel, right, which is, typically you would take assignment of the shares and sell a strangle, but we already had the shares. So we rolled the 4-strike call down to a 3-strike call, which is a little bit more conservative, as we have mentioned right here, to lower our basis more. And then we legged into a strangle by increasing the amount of money we had at stake on this play and further lowering our break-even price, because we know if we sell a 2.5-strike put on BBIG for 16 cents, if that gets assigned, that's the equivalent of scooping shares up for $2.34, which is absolutely not a problem right now, and that contributes to this lower break-even price that we have. So we're perfectly content to sit where we are right now. Our max profit on this trade is going to be anywhere above 3, right? You can see we're sitting on a 518 profit if it expires at 323. If it goes down to 3, we're still sitting on a 518 profit. It's not until we start getting down to like 275 that this number goes down. But as you'll notice, since the box is still shaded green, it's still going to be a profit. And that would, really represent an enormous drop in the stock. If it went down to 263, that would be a 30.61% drop in the stock. But again, it's one that through our option selling strategies, our patience, and our ability to scale into these plays that we're going to be able to handle without taking a loss. How often can you find yourself in a long position on a stock and not lose any money if it drops 30% in 2 months. I think that is fantastic value. And that's one of the best examples I could point to as to why we do what we do here on this channel. But let's get this back to where it was. This is our current position. If it finishes above 3, we're taking home $518, which on our $3,800 investment is going to be a 13.582% return on capital in about a month and a half, which annualizes to over 100%. And if we could ever complete trades that annualize to over 100% on a consistent basis, we are going to have a very, very, very good year in the stock market. So let's go back to our weekly tracker, going further down the list. Visalink, we rolled those down to 2.5 strike puts. Those expire in August. We don't really need to talk about those too much because, not a lot of action on that one right now. We got out of our ALEC play, which if you take a look back at our trade performance, which I still need to update for some of these, admittedly. ALEC right here, that was us essentially closing out this trade. It was an IV, well, it was an IV reversion trade. I have this mislabeled. But that one spiked up. The implied volatility dropped back down. That killed the premium on the options we sold. We were able to get out for a $760 profit on $5,100 of collateral in just 2.5 weeks, which is a 14.76% return. Very, very, very happy with that, even though on a week-to-week basis we lost $200. But as you can see from prior weeks, we made a little bit more week after week after week. So, well, we did have a $200 loss just on the week to get out of that play, which sometimes you're going to have to do. Overall, that trade was a big winner for us, so we're always happy to lock in those big winners when we can. APT was one that we sold in anticipation of expiring, this upcoming Friday and holding on to it this week at an 8-strike put. But luckily for us, if we pull up the APT chart, we could see on the back end of last week, this thing shot right back up. The premiums that we sold on the 8-strike puts for 21 cents are now down to 6 cents. So we got out of that trade, locked in a $150 profit in about 24 hours. Perfectly happy with that one. SOL is another ongoing play that we've got. If you pop down here, we've got the 7-strike puts still rolling, and we can take a look at, what we've done so far on that trade. If this thing loads, come on. There we go. So SOL, we got in when it was at 810, and we could pull up the chart too to give a little bit of context to this explanation that we are running through right here. We'll back it up to the 20-day. We got in at 810 right about here when it was taking this leg down back on, well, maybe not on July 8th is when we got in on this one. So this day right here. So we got in right around here in the morning when it was pulling down to this 8 level. But from there was some really nice premium on the options, right? We know off the bat if we sell a 7.5 strike put for 25 cents of premium, that's going to knock our break-even price to 7.5 minus 0.25, giving us a 7.25 break-even price off the bat, which already was a decent 1-week reduction in break-even price. So we were super happy to have that opportunity. And then from there, it dropped considerably, right? Our 7.25 break-even price, which is right around here, got broken through. So we closed that out. We basically rolled from 1 to 2. So we closed for 40-cent debit, which is a 150 loss momentarily, not the worst thing in the world. And then opened up 7-strike puts, and by rolling down to 7-strike, we increased the probability of max profit, because formerly we needed it to finish above here. When we roll down to a 7-strike put, that means we only need to finish it above here. So from a, probability of profit perspective on the trade, that looks a lot better. And to, make up for the fact that we had a 15-cent loss here and we were selling these for a little bit cheaper than what we closed out for, we sold 5 more. We slightly increased our position. We'll remember that, one of the biggest parts of the HT wheel is making sure that we're starting small on trades so that if they do turn against us like this, we have some sort of recourse available to keep that going. That's exactly what we did. We even added a little more, 6.5, when it dipped even further back on that Monday or Tuesday of last week. I forgot the exact day that we entered into those, but we know that 13 cents of premium is a big help, gave us another $130, which further lowered our break-even price right here. It lowered it by 9 cents, so not a ton, but any decrease in the break-even price is a good move in my opinion. And then we got to the end of last week. SOL finished about 698, so pretty much dead on the number. However, we closed our 7-strike puts for 10 cents because if we take a look back at what was happening on Friday, it did dip down to roughly the 680, 690 level. So we said, hey, at that point, there wasn't a lot of extrinsic value. We could, lock in a gain on this individual leg we knew that our 6.5s were probably going to expire worthless. So we were happy to let these expire, close these out, and then move on to what we were rolling into next week, which is going to be 7-strike puts again. We sold this for 20 cents. If you take a look at the SOL option chain, these are actually going for about 35 cents now, which if you're able to get a fill in, the mid 30s on that, I think that's going to be some really solid value, because even if you're not already in this play, you could put yourself in a position where off the bat, if you sold the 7-strike puts, you're going to be looking at a 665 break-even price, which is down here for 1 week of time. So it could trade flat, it could go up, or it could drop, but just not down to 665, and you're still going to hit a profit on that trade. So I really like the way that sets up, so much so that I was thinking about maybe adding that in there. But we look at our break-even price. We see our break-even price is 653. Like I mentioned a couple of minutes ago, we like trades that lower our break-even price. If we sold more of the 7-strike puts at 35 cents a premium, that'd be the equivalent of picking up shares, as we mentioned, for 665, which is above our break-even price. So making that trade would increase our break-even price. So while we think in a vacuum, that's a good trade, in the context of our overall trade with SOL right now, it would raise our break-even price. So that's not something we're looking to do. I will say for this upcoming week, if these 6.5 strike puts start getting up to 15, or you can get a fill in the 20 area, that might be something that is worth looking at, because 20 cents a premium on a 6.5 strike put is the equivalent of getting shares for 630, and that would definitely lower our break-even price. But right now, so far, so good. This thing finishes at 698 next week. We're going to be looking at an 11.8% return on capital, and that's just 2-3 week duration on this trade, and 11.867% return on capital in that short of a period of time annualizes to about 540%. So despite the fact, again, similar theme here in us recapping some of these trades, despite the fact that this stock has dropped 13.83% on us, we are still in a position where it could stay flat. It could still be in a position where it dropped 14% on us. Yet, due to the premium we've identified, the way that we've scaled ourselves into this play, and the patience in rolling down and out and slowly increasing positions, and the amount of capital we have in the play, has put us in a position where we have a really nice break-even price and can still pull an annualized return of over 500%. So we're really happy with the way this one's been turning out. I think best case scenario for me is it finishes right on the number at 7. We could call this trade a win and then get into another SOL trade, assuming that the premium is there. And I would have to assume that it would be, because that thing has had a lot of premium. A question from YouTube, David James SC12, asking about the Google Sheet template. If you want to use this exact template we're using, you could literally go up here, File, and I think you can just download it and then input your own information. We actually also, in our Discord server, to take a quick tangent from here, if I pull this over and go into our profit tracker channel in our Discord server, I did make a small tracking template, and it's nothing, too special. It's pretty basic. I think some parts of it are still pretty manual, where you could just track your actual trades. So maybe not the most helpful thing in the world. I think what might be easier is literally just downloading what we have currently here. However, to that point, and something I do want to say, I don't know if I'll be able to open it right now. Let me give it a shot. Let's see if I can find it. What I was working on, and something I'm going to release soon, if I can find the file on my desktop. Bear with me, bear with me, bear with me. I'm just going to search for it. There we go. Excel's opening another window. It's coming. What I've been trying to do is work on, creating an Excel offline, template that you can use, a lot more automated than what we have, right? For what we use, we're inputting this manually. We go over here, we're inputting these trades manually. What I'm trying to do is get to a point where if you go here, we've got some VBA that we were working on. You'll basically get a box like this, an input box, and if we, oops, they've been disabled. I'll figure that out later. But, the idea is you're going to hit a button that's going to say add a trade. You're going to get a pop-up window like this. You're going to be able to add it all in there, and then it'll all self-populate, and you won't have to worry about calculating things or doing things like that. The only responsibility you're going to have from the tracker perspective is just filling out this box every time you enter a trade. So that was a quick little tangent. That's something that I've kind of been working on a little bit as a side project, and I'm hoping to have finished up and available to you guys at some point here in the next couple weeks. But it is definitely a learning experience for me as well. So that project is lagging a little bit. Moving further down, we just talked about SOL, SPC. That was another kind of IV reversion type play. But let's talk about IGC, and that'll be the last thing we talk about from this list because we did have some nice ins and outs. If you really are curious about what we were doing, what we were looking at, all of these are posted in the HT Trades, and we did go over a few of them in the Trade Ideas channel that we have right there. So if you're really interested in some of what we did last week, you could review that there. But what's more important is probably, and something that you guys are a lot more interested in, because I do tend to take up a little bit too much time with the recaps, but it's probably going to be a lot more interesting and relevant to you guys about what we're looking at for this upcoming week. So the last thing we'll talk about from last week is IGC, and this is another one we tried to go with that IV reversion type strategy. You see IGC spiked way up to 465, and if you check the news wire, it was off of positive news, right? So if we see spikes and there's no associated news, that's not a good candidate for an IV reversion play, because the basic thesis behind this is that if there's a spike like that and it's good news, you can set up a play with break even or was trading before, because in theory the good news means that the stock going forward is going to be worth more than it was before. But with that said, we see this big spike. If we go to the studies really quickly, I could pull up implied volatility, and you'll see there was a corresponding spike in implied volatility, which eventually has kind of started to taper off, which, as from a implied volatility standpoint, that's exactly what we expected. However, we didn't quite expect it to pull back so hard so quickly, unfortunately. And we are in a trade right now with, we've kept the trade small, so it's not going to be anything that tears apart our portfolio. But we've got about a 195 break-even price, I think. Let me get an actual number on that and go over to the tab itself. But you'll see we first started this playoff by selling 2.5 strike puts off the bat, which we know 2.5 strike minus 42 cents of premium gives us an initial break-even price of $2.08, which on this chart, when we were, this is roughly the area in which we opened that trade, we said, okay, a 208 break-even price, that doesn't look too bad. And I still stand by that. Just because a trade it doesn't work doesn't mean it was a bad idea. If we stick to the fundamentals and the processes and the strategies that got us here, we're going to have some losers, but in the end, there's going to be more winners than losers, and we are going to make money in the long run. So if this was one of your first plays, if you're new to following us and this is something you tagged along with, don't get discouraged by something like this, because while this wasn't, this is probably one of the worst outcomes from a short-term 1-2 day perspective upon entering a trade. The fact of the matter is this thing's hanging out at 185 and our break-even price is 192. So this could finish exactly where it is in, a month from now on August 20th. And we're going to have lost less than $100. And we know from our HC Will strategy, this isn't just the end of the play. The plan from there would then be to take assignment on the shares, sell covered calls. And we could see right now kind of at the money, calls are still offering about 35 cents a premium. So we anticipate that, because IV is going to continue to drop, right? It's not going to still be up here come August 20th. But the fact that you could be 10-12 cents out of the money and still get about 35 cents a premium leads me to believe that if, IGC stays around this price level, we'll be able to get 15-20 cents a premium, which drops that break-even price down to roughly, $1.70. So not a huge issue to have shares with the basis right here in the long run on this one. Again, we kept the position pretty small. I guess acknowledge the fact that it was going to be a risky one. I don't want to get too much further in. If I did, it'd be selling the 1.5 strike puts, but there's really not enough premium on those to make them worthwhile right now. And the fact that they don't have much premium on them indicates to me that the market isn't pricing in too much of a risk of a further drop from here. So I like where we're at. Obviously, it sucks to have it drop so much in the first couple of days of the trade, but this thing could pop right back up to 250 like nothing ever happened, and there you go. We're sitting on a 15% gain. So one of those things, just sit back, let your play go to work. Don't even think about this one on a day-to-day basis. We'll just revisit it come August 20th and then figure out what we want to do from there. And that should sum up what we did last week. Again, made some money, slightly underperformed the market, but I'm never going to complain about when we're making money on a week-to-week basis. So that leads us in to what we're doing for next week. The UWMC play that we already talked about, those are going to be sitting in there until August 20th. ICLN, again, too boring to even discuss on here. Corsair, we've talked about a little bit. In reality, we've talked about pretty much everything on here except for maybe DD and Clover Health. So we could discuss those really briefly. And touching back on our hedges, we opened these for $1.05 last week, and they shot up to 225 before market close. If the market just, I think we've got about a 0.1, 0.2% cushion on the upside. It's already dropped 0.2%, so that cushion's even bigger as it stands right now based off futures, but those would both hit max profit and put us right back in the green like nothing ever happened. But yeah, unfortunately, we do have this decently sized SPX position, and that might swing our profits decently for this upcoming week, but nothing that I'm terribly worried about. 7/28 is a Wednesday expiry. We're going to reevaluate things Monday because, like we said, we're going to be proactive. We're going to get in front of it when these move against us. We're not going to be closing these out for $3.50 or $4 on the day of expiry. We're going to be closing these out for a little bit on the cheaper side so we don't risk that, not catastrophic, but, max loss, which I can't find an adjective for, but where it's not going to kill us, but it definitely wouldn't feel very good. So that's our plan with that one going forward. But let's talk about DD 6-strike put. There's definitely a little bit of regulatory risk there. The Chinese rideshare, the Uber of China, which IPO'd a few weeks ago. We could probably back all the way up to the IPO on this chart right here. There you go. Maybe we can get a little further back. No, that's the IPO right there. Okay, so as you can see, it IPO'd at roughly the 16 level, shot up, went back down. And then all of a sudden, the Chinese government, which is something that is inherently a risk with any sort of China investment, they decided that they might weigh some sort of penalty on them for the IPO that they had in the United States because the Chinese government maybe cares a little bit more about power than profitability for their companies. So we saw a pretty big drop off at the back end of last week, going from 12 down to 8.13. But the fact of the matter, at the end of the day, this is China's Uber. The company has value. This huge drop off has created this enormous spike in implied volatility, and that's something that we wanted to take advantage of. So when you take a look at the options chain here, what options are going to decay the quickest, and that's going to be those that are the furthest out of the money. And we identified those not quite as the 5-strike because the 1.52% return on risk, the price between 5 and 10 cents. I didn't really like the idea of a fill right there. We were able to get in on the 6-strike puts for 19 cents a piece, meaning that our break-even price is going to be 6 minus the 19 cents of credit, meaning we have a $5.81 break-even price on a stock that's trading at $8.06. So that means it's currently trading at $8.06. Our break-even price is $5.81. We can withstand a $2.25 drop, which on a stock that was trading at $8.06 means we now have a trade in plain English where as long as DD doesn't drop 28% in the next 5 days, we are going to be sitting on what is a $380 gain. And sometimes it is nice to read those trades back in plain English, think about what you're actually betting on, so to speak. And this seems like a really nice value proposition. That 581 break-even price is something we've got to zoom out here for. 581, close enough. So, while there was a lot of a decent drop-off, we can take a peek at the RSI really quickly. I almost guarantee you we're going to see some dark blues. And there you go right there. It's super, super oversold. Honestly, one of the lower numbers I have ever seen. So definitely playing a bounce right here. If come Monday, come Tuesday, this thing bounces above 8 and we see the premium on here drop to, under 10 cents, we're going to take that opportunity to take half of our potential max profits right there so early in the week and free up buying. With the SPX, again, we like to talk about some macro trends in here. I feel like we are super, super, super overextended, and I just always want to be wary of the downside risk that a potential market pullback would carry. So buying power right now is so important, which is why you're seeing us, lean towards taking profits Monday and Tuesday on this if we can get this under 10 cents. And why you saw us get in and out of so many different plays last week when typically we would normally hold those to expiry. Buying power is flexibility, and flexibility in market conditions like this is, incredibly important. So that is what we are going to be, that's going to be our goal. That's what we're going for this upcoming week. And that's going to be why we're looking to get out of that one early. Clover is the back end of the one play that we didn't quite talk about when we were doing the recap. But again, one of those, we got in at 9.2, had a big drop, but our break even is down to 744. So if Clover finishes above 70.44 this week, we're going to finish with a profit overall on the trade. Typically, you'll see that we opened both of these initial play. These were both opened at the same time. So we had 20 as the position size, but we now have cut that down to 10, which is reduces our risk, frees up a little buying power, and then lets us get into a position where, hey, if Clover drops down to 750 this week, then we can get those 10 extra contracts back in play, get back to our normal position size, and on top of that, further lower our break-even price. So that's the plan right there. Just let that one ride. If it gets back in the 750, 760 area and we see an option, let me see what the strikes are for this upcoming week. It looks like the strikes, yeah, they're $1 wide strikes right here. So if we get in a position where the 7 strike put is offering a decent bit of extrinsic value, it might not be the worst thing in the world to buy on 10 more of those if this jumps up to 15 or 20 cents and continue to drive this break-even price down week after week, because this thing has been dropping, and that's why there's put premium on it, quite frankly. But every stock that drops has bounces, and if we just keep lowering our break-even price on a week-to-week basis, we're eventually going to catch one of those bounces and be able to get out for an overall profit. Maybe that'll be this week, maybe it'll be next week, maybe it'll be a month from now. Who knows? The best thing that we could do in the meantime is kind of conservatively cut this play in half, free up a little bit of buying power, and be patient and wait to potentially lower our break-even price again. We've got Jules saying IHW wants me to take a look at SAVA, and of course I can never ignore that. We've got some. Here we go. I'm taking a look in the main chat room of our Discord really quickly on another screen. Let's see. Okay, so it looks like SAVA is presenting about Alzheimer's on Monday, and they're kind of rocketing. So let's take a look at their chart. SAVA was something like, oh, absolutely. They've gone from 45 to 120. Oh, excuse me. It's even crazier than what I initially thought. They've gone from, sub 10. It looks like 6.7 is where they bottomed out back in December of last year to over $100. So obviously a move like that is going to carry some pretty significant option premium. The expiries are out in August. The implied move is $44, meaning that these are pricing in a move of 44 up or 44 down based on the premiums that they're offering. Definitely an interesting one. There are tons of premium. Let's see how far out of the money we can go and still get a little bit of cash. Looks like 50 is maybe kind of, you're only getting a 1.94% ROR. But the thing about a lot of these biotech stocks is sometimes you'll get decent leverage. We know that if we wanted to sell 10 50 strike puts, it would take, $50,000 of collateral. Whereas with these, it only takes 13.9 of collateral with the more generous margin buying power requirements. What scares me about stuff like this, though, and why I feel like sometimes we can fit biotech into our strategy, but when you see a stock that has a run up like this, premiums objectively, they're good, but they're good for good reason, because, this thing is at risk of falling through the floor and putting us in a position where we sold these puts. We now have to take on a huge position, and it's fallen so far, so fast, which is typical of biotech when things go poorly, but it's fallen so far and so fast that there's nothing that we could do to continually lower our break-even price on that. So, yeah, this is one I probably wouldn't look at just from a purely a cash secured put perspective, just because of that assignment risk. I wouldn't want to hold a large position in something like this. It doesn't quite fit into our RV reversion strategy because, maybe if we got in back over here, but again, there's still some significant downside. It doesn't fit the mold of something like CERE, which is what we previously did, where you're going to see this big spike right there, and then we were able to get a break-even price on a trade right around here. That is where we're able to kind of, shoe tech names into our strategy. But, what we've got with SAVA is definitely a little bit different of a setup. So as far as what we do, I would stay away from it. I don't know if there's some opportunity maybe on the extrinsic value that we're seeing deep in the money. If there's some sort of there's extrinsic, if there's some sort of big skew. It doesn't really look like it, right? If we look at the 175 strike, for example, there's $9 of extrinsic value. And if we look at the call, there's roughly $9 of premium on the call. So there's no skew to either side, no advantage on the call at put side as far as extrinsic value is concerned. So, one that definitely one of those that are tempting because, I'll just sell 10 of these and I'll make 2,000 bucks off, I guess that would be a little bit bigger of a margin requirement. But, you might say, I can get myself a $50 cushion. But at the end of the day, we want to avoid putting ourselves in positions where it's even remotely possible for such a big downward move to take a huge chunk out of our portfolio. And that is why I would probably recommend staying away from that one for now. So there we go. I guess he had to be up at 4 a.m., says Jules in the YouTube chat. So we hopefully can get that message back to him that I don't know if SAVA is the greatest idea. But with that said, that kind of takes us to the bottom of the list that we had. We can go through some scans. We could take a look at some of the different strategies. We could take a look at earnings that are upcoming. If you guys have any tickers you want to take a look at, feel free to throw them into the chat and we could start doing that. But I think an interesting place to start, as per usual when I'm out of ideas, is going back to our high return on risk put scan, which we're going to scan for right here really quickly. Our options are going to come up very shortly. Come on, come on, come on. And there we go. Let's get them sorted by ROR. And there you go. As you can see at the top of the list, and this is kind of where we got that idea from, DD is right at the top with close to them, basically at the money puts, offering 9.97% return on risk, which is a huge number for 1 week's time. And again, the way this scan is set up, right, we identify areas with a lot of implied volatility. We've got these set up to a minimum of 0.01% out of the money. And that ensures that these are all out of the money puts. So all the value that you see that you're selling is extrinsic value, which is the value of the option that's subject to time decay. And the 2 to 7 days to expiry filter ensures that we're looking at things that expire this upcoming Friday. We're looking at weekly options. And then this 1% ROR filter, just make sure that we're cutting out the thousands of results that would come in for, super low numbers and make this an enormous list. And last but not least, this volume filter with the minimum of 50 ensures that there's actually people trading these options instead of getting some erroneous results where there's just a weird spread no one's really traded, and it's kind of just, not a valid return on the scan. So that is how we have that set up. That's what we're looking at right now. We've got one question to take a look at PSTH. We can absolutely take a look at PSTH really quickly right here because this is one that we were in about a week or two ago before we exited. So as many of the people who are involved with us know, because this has kind of been one of the darlings of our Discord server, PSTH, one of the SPACs led by Bill Ackman. There were all these promises that, they've got this huge amount of funding. They're going to go take this unicorn company public, and it's going to be incredible. And that's what you see right here when you see this huge run up from, I don't know, roughly like $20, because roughly that $20 level is net asset value for PSTH. We had all this speculation. SPAC fever, I guess is you could potentially call it, was hitting in the back end of 2020. And it peaked at roughly $34 before starting to fall back down. And then it was announced that they were taking United Music Group, maybe not United. I keep forgetting what the U stands for. But basically a large music company public. People didn't like that because when you start speculating about, space-related companies, or they're going to take Bloomberg, or they're going to take Stripe public, it's not really a home run to announce that you're taking a music label public. So a lot of the market reaction to that was pretty negative. And then eventually, even though they announced that as the target, they then announced that PSTH wasn't going to take them public, and then Bill Ackman was going to take them public. Universal. Thank you, Jiggy Snipe, for keeping me in check. I love the fact checkers. But yeah, then the news came out that PSTH was not going to be taking them public, and instead Bill Ackman's hedge fund Pershing Square was going to be taking them public, or executing the deal on PSTH's behalf. So as of right now, PSTH is trading roughly around net asset value, and they don't have a target. I think they have 12 to 18 months to come up with another target. But is that good? Is that bad? I think right now is a great entry point, which, from a chart perspective, absolutely. It's about the lowest that it's traded in the last 180 days. And the great part about, these SPACs is that while they are a SPAC, and this still is a SPAC, considering that there's no target right now, there's no merger date, it's going to be a SPAC for the next few months at least. There's not a lot of downside below net asset value, because in the event that they're not able to find a company to take public, The way the SPACs are structured means that the investors are just going to get the net asset value back. And net asset value is right around $20 a share. So there's very, very, very limited downside on this one in the near future. So how could we potentially take advantage of that? If you look at the weekly option chain, one that used to carry so much premium on a week-to-week basis, the premium is kind of dead now, which is a little bit disappointing because, it would be one that would be nice to get in on. However, I guess maybe this is not entirely in line with what we typically do with our strategy. But if you have a stock you're bullish on, we take a look at it from our lens and say, hey, the premium's not there. It's not a great option selling play. If we like the stock and the premium sucks, we could put ourselves on the other side of that trade and buy a call, which is kind of similar to the idea that we had with IPOF, right? So if we look maybe a month or two out, we look out to September, we could buy these 21 strike calls for 30 cents a premium, which still isn't the greatest value in the world because your break-even price comes in at 21.3. Right up here, but you put yourself in a position where there's relatively limited downside, and that is demonstrated by the fact that 2 months away in September, there's no put premium on anything basically below 20. So the risk that this drops below 20 in the short term is so low. And to kind of add to this discussion of and the point we're making of limited downside risk, when the stock market is, not that it is right now, but if you're fearing that the stock market is overvalued and that there's going to be a pullback in the market, having something like this in your portfolio as a long position isn't the worst thing in the world, right? Because if the market drops 1, 2, 3%, this still isn't going to fall too far below net asset value. So in a way, it's almost like a hedge where, limited downside, but potentially, theoretically, some sort of upside. But I think a relatively safe place to park some cash if you've got it on the sideline. I don't know about on a week-to-week basis if I just would get in there and start buying the shares and then selling 21 strike to knock my basis down 10 cents a week. I don't even know if that's something that's worth it because I don't know if you'd want to cap your gains at 21 if they come out with some news next week and say, okay, we're actually taking this company public and people get all excited and it shoots up here. One of those situations where it probably isn't worth the 10 cent or 5 cent premium you're getting to cap those potential gains at 21 a share. So that is something that, our option selling strategies honestly are not a great fit for this one, but I think this is a good stock. Just from an investment perspective, adding a little bit of diversity with that limited downside into your portfolio. And maybe if you want to go into the money a little bit on these September ones, there's really not that much extrinsic value. So you could find yourself in something of a leveraged stock position if this thing pops back up to, I don't know, so you could buy these 19 calls for about $1.60 a piece. That's 10 cents of extrinsic value on those. If the stock jumps back up to, what would it take to make these $3? If it jumps up to 22, you've doubled your money. And that doesn't seem too far-fetched after we've seen the kind of movement that we have. It was trading at 22 just back July 9th, 2 or 3 weeks ago. So using a little bit of leverage by going into the money and buying a call where there's not a lot of extrinsic value, you could find yourself in a decent position on that. I don't hate the idea of potentially getting in on some of these. If good news comes out and they shoot back up to 24 or 25, you're going to be looking at a very nice profit with these. And what we could do, I think one good way to visualize what that profit would look like, if we go to analyze simulated trade, PSTH, we go to September 21. We're not going to do a straddle. We're just going single leg right here. So if we don't sell these, we buy some of these for 160, which is going to be the midpoint here, assuming we get a fill on that. Let's take a look at the risk profile, right? We know that anything below 20 is relatively, it's not really in play. So we can consider 20 our most immediate downside risk. As you can see in the bottom left here, if I move my mouse, the numbers change. But the numbers that come up right here at 20, it means, and the blue is what we care about because that's the value at expiry. But you'd lose about $600 if it dropped down to 20. However, conversely, if the stock started flying back up because there was some good news and we get back to 24, you've now made like $3,400, and your break-even price is right at 20.89, which is barely above where it's currently trading. Your break-even price, if you got 160, would be at 20.60. So that is barely above where, there you go. You can see it right there where that red dash is. It's barely above where it's currently trading. You're able to get some decent leverage with no extrinsic value on something that's so close to the money. So some really, really nice leverage on that stock right there. It costs about, it doesn't look like there's too much of a margin requirement to enter. I don't know if that is, fake or not. We could put this in the trade screen and actually see what the deal is if we want to buy some of these. But I would imagine your margin buying requirement is there you go, $1,600. That's the debit that it takes to enter into the trade. So maybe that would be something nice to throw, a couple $1,000 at. If it doesn't pan out, you're going to be losing $200 or $300 over the course of 2 months, which is something you could probably pretty easily, depending on your account size, right? You could step this down. I'm just talking about this in the perspective of mine, but you could step it down to as little as one contract where if it doesn't move between now and September 17th, you're looking at a $10 loss. So it's not even that big of a deal. If it goes down to 20, you're looking at a $55 loss. But then, if it runs back up to 25 or 26, you're starting to look at a $400 or $500 gain. So that's something, I don't hate the idea of doing something like that, having a long position via an in the money call with basically no extrinsic value. So that might be something I take a look at tomorrow morning. I like that. I like that idea. So with that said, we can maybe flip back over to the scan. We're coming up at about an hour on the stream. SOS, this is one that is one of those crypto related stocks. This thing used to be up near 10. Where is it now? 254. Good lord, this thing is falling hard and fast. If we go to the 5-day, it looks like a lot of that premium on the 2.5 strike puts is from this little spike that we saw right there back on Thursday morning before the market opened. Let's take a look at the option chain here. We like that they've got weekly options, and I like the fact that the options are at 50-cent intervals because that gives you a little bit of flexibility in entering into a trade. So if we wanted to sell 10 of these, I can't imagine you get too much leverage. You get no leverage at all. But if you wanted to sell a 2.5 strike put, you would be able at max profit to get an 8.46% return per week. Looking at the chart though, it's one of those things where your break-even price would be at about 230. And if we look back to the last 20 trading days, 230 is relatively the base, not the worst idea in the world on this one if you were trying to get in on something that, quote unquote is a little bit riskier. And anything that we pull from the top of our scan is going to be riskier. So that's just kind of the territory that we're dealing in right now. But, a lot of the time it's easier to look at things just from a pure numbers perspective. Do we like the fact that the stock is traded between, 230 and 350 and that we can get in with a 230 break even price? When we lay it out like that, that doesn't seem like too bad of a value. But, not something that I think I'm going to find myself in, but we're just throwing some ideas at the wall, seeing what sticks. I wouldn't say that's a bad play. What I do think would be a bad play is something like NEGG 24 strike puts, where you might say, okay, we're looking at Newegg, a 24 strike put. There you go, that 8 whatever percent return per week, and you get a break-even price of $21.90. And you might say, okay, that seems decent. That could handle a big drop in a week. But when we take a look at the Newegg chart, this thing less than a month ago was trading at 10 a share. So a 23 basis really isn't near any long-term areas of support, right? Because this thing was trading between 3 and 10 before it got squeezed up because it was a low float, heavily shorted stock. And that's kind of just what happens with those sometimes. But, that 22.90 break-even price that you'd be able to get on these right here, 22.30-ish break-even price that would be getting on those right there, still really isn't that great of a value because there's still a long way down to 10, and a 23 break-even price on a stock that falls down to 10 is not very manageable. Whereas if we look back at SOS, it's at least nearer some levels of support that we've seen in the near term, right around that 230 level. So you could maybe kind of rationalize this move a little bit more than the Newegg move. But this one decent, but when we look at the charts, Newegg, an example of something where the downside risk is just too heavy, and that's really the number one thing you should be looking at, right? We can make all the money in the world if we only look at max profit on a week-to-week basis, but something that's so important is for us to evaluate downside potential risk on every play, because not every play is going to go our direction. We need to know what we're going to do and need to have a plan about what to do if something like that does occur. So that is why we always love to evaluate the downside risk on a trade. Maybe looking at a couple more of those. FFIE, literally never heard of this stock in my life, but let's take a look at the premiums. Faraday Future Intelligent. All right, man, what's going on right here? Looks like this thing just started trading potentially. It looks like that may be the case. Live news, what's going on here? Let's see. It looks like this was formerly a SPAC. So they've now been listed on NASDAQ through a merger. What date was this? 7/22, and that's when this comes back. Faraday Future shares climb after merger with SPAC. There you go. PSAC was that one. And oh, okay. I'm familiar with PSAC. Didn't realize they were just merging. If we back it up, I guess we could take a look at the PSAC chart. That one, I think, got hit pretty hard over the past month or so. If we go to the 180 day, yeah, I mean, maybe not terribly hard. It went back down to, there we go. This is what I'm talking about. It dropped pretty hard from 18. It was one of those that spiked on the front end, so nothing too crazy. But now it is FFIE, and there's a lot of premium on that because it's a SPAC post-merger. What do we know about SPACs post-merger? Typically, we could pull up our favorite stock of all time, Hyliion, if we go back to the 1 year chart. Typical lifespan of a SPAC was trading right around asset value, and we might need, wow, we've got to go further than a year back on this one. But yeah, typical lifespan, this is what you're going to see and is typical with most SPAC charts that you're going to look at. Trades right around that asset value for a long amount of time. There's rumors about who they're going to be merging with. Rumors get confirmed. You see a big runoff. And then you get the merger. And this is right around where the merger was. We dropped from 50 down to, sub 10 ultimately. Those of you who have been following with us know and have probably heard me beat this to death about what happened with Hyliion. But point being, when we look at FFIE, and I definitely need to change the way this chart is shown, they just merged. They're at 15. There's probably a decent bit of downside potential in the near future, but definitely not as scary as Hyliion going, into a merger at 50. CCIV is one that's a little bit scarier right now because it's back at 25, headed into a merger. So we're starting to see maybe that fall towards the end of it. CLOV, same deal, was a SPAC. They had the merger, fell off the face of the earth. Their merger was back here-ish, roughly. Misspoke on that. This was a big squeeze that they had because they were so heavily shorted. But yeah, point being, when there's the merger, it falls down. CLVR is another example, one where they had the merger, they fell down. Actually, that was around New Year's. Where was it? Right around here, they had the merger and then fell back down below net asset value of 10. So there's no reason for me to believe FFIE is remotely safe at the levels it's at. Maybe one if you're a fan of the company, a fan of what they're doing. The premium still looks good. Just to keep on the watch list for now, and if it falls back down to that 10-ish range, right around where NAV, net asset value, previously was, then it might be worth taking a look at something like that. Or if you didn't want to wait, or you wanted to pay, or get paid to wait, you could go all the way out to August 20th. Just go ahead and sell that 10 strike put, and if it gets down there, you're going to be getting assigned shares at about 965 basis. And if it doesn't get down there, you're getting paid $450 if you sell 10 of these things. So not the worst thing in the world either. One thing that I might take a look at really quickly is if there's decent margin buying power privileges on something like this. It looks like normally for something like this, it would require 11.7, and it requires 4.5 with, so about a third of the fully cash secured buying power. So, okay-ish leverage if we're looking at that on a return basis, that $300 return divided by what we see right here, right? The 45.80 of collateral is going to be a 6.5% weekly return on capital. Decent-ish number, especially for something that's kind of far out of the money at 12. But as we showed with a lot of these stocks, we don't want to be caught in a post-merger drop. So one that might be interesting for us to just throw on the onto the watch list, and the watch list that I've actually been using a little bit more, if I could find it, there we go, is this one right here, the HT watch list. And I will throw that in. Where's it gonna? A, B, C, D, E, F. Thank you for bearing with me as I try to remember the alphabet. Insert row. FFIE. There we go. We're gonna pull these down. And our entry target here, let's take a look at the chart. I mean, it's one of those things, if we go to PSAC, that was the SPAC it formerly was. I don't know if we're going to be able to identify any areas of support. It looks like 12 should be a decent area of support because it's bounced off that a couple times. Beyond that 1170 at these levels, and then about 1080. So maybe keep an eye on it, and we're gonna put an entry potential entry target at where's this bottoming out? 1239. We'll call it 1225 will be the entry target on this one. And this is our HT watch list. This is something that's going to be available when we roll out our HT premium subscription. So that'll be available for you guys. It's got all these different stocks, all different price targets. It's going to only get longer as weeks pass, but we've got notes in there so you know where our head's at, what our plan is, and then when we execute on those, another thing that we are going to have in that premium package is going to be, blog posts with fully detailed trade ideas to say, hey, here's where we are, here's where we want to be, here's where we anticipate that we might be, and then here's, our contingency plan if things go against us. But we'll get back out of that and back to what we were talking about. FFIE is now on the watch list, and that should kind of close the loop on the discussion with that one. Popped up at the top of the market, at the top of our scan. And so that's why we take a quick peek at it. And Dashio saying SOS, touching back on what we were talking about earlier, saying it's China crypto, right? And you are 100% correct. Mentioning that Bitcoin's mooning right now. I did not know that. So yeah, very safe assumption that since it's a crypto-related stock, it's probably going to gap up a little bit when the market opens, since they just tend to follow the direction of the crypto markets, and if those are up, those crypto stocks are going to be up as well. So maybe that 2.5 play won't be exactly what we were looking at, but hey, definitely worth taking a peek at Monday morning to see if that kind of value is still there. So with that said, that's probably CCIV, like we just talked about. That's at the top because they're heading into a merger. RIDE, that one is on there because they are kind of at risk of not even being able to continue as a company. So when we talk about the number one rule of selling options, it's don't sell puts on something that you're not comfortable owning. While the put premium here looks nice on a week-to-week basis, and I think you can get some decent leverage, not that great, but from an ROR perspective, it's objectively really nice on a week-to-week basis. However, rule number one, this company, debatably does not have enough cash to continue operations, and actually they're an electric vehicle company, but they debatably don't have enough cash to actually get into production and get any vehicles made. So that is why they've dropped off so sharply. That is why the put premium is enormous, but that is those same reasons why the put premium is big and that they've dropped off so much are the same reasons that I do not want to try to take advantage of something like this, because if the stock did continue to drop and I were assigned on these positions, this isn't a stock I want to be assigned on. And not every ticker that we see with decent premiums and every single ticker that we see come up on our list of option scans is going to be a good entry for us or a good trade opportunity. These really are just places to start informing trade ideas, and having something like that come together. And a great thing to just run down the list, kind of like we've been doing on the stream tonight, saying, okay, this one looked good, I'm in on that. This one looks all right, and then you go to Newegg and say, okay, this one doesn't look as good because there's some serious downside risk, FFIE, so we're going to throw this on the watch list. But a great place to start, and scans like this are where we, start a lot of our trade ideas, in addition to just having tickers on our watch list out here that we're familiar with. We understand the way they move on a day-to-day basis. So if there are any moves that are out of the ordinary, we're going to be able to capitalize on those. So I think we're a little over an hour now on the stream. Again, going to be one of those weeks where we've got a decent amount of buying power as we head into it. So a lot of what we do for this week, and that you're going to see on our recap for next week, is going to be handled on a day-to-day basis this week. More so responding to moves that we see in the market, as opposed to just having this laundry list of plays we want to make Monday morning when we wake up and crack it open. So that's going to be one of those things where just stay tuned in what we're calling out and what we're talking about in the Discord, because that's where we're alerting all of our trades real time as we make them, and talking through trade ideas, evaluating potential opportunities as we see them in the market. But there's only so much I feel like we say this every week, but there's only so much we could figure out, Sunday night. When we look at things like this, a good way to get a few decent ideas, right? We talked about PSTH. Some of these, if you guys aren't already in on them, are still decent entry opportunities. But I like what we're at. We've got a decent amount of buying power, and in uncertain markets like what we're currently trading in, having buying power is having flexibility, and having flexibility is a huge advantage, because that lets you, if things do pull back, you're not worried about, what positions you're in that are going to get margin called. you've got that cash in your back pocket to say, okay, I'm not getting margin called. What positions am I selling right now and making some money on? So that is going to be the way that we approach this week. I've never had a pullback where I wish I had less buying power, so I'll leave it at that. But with that said, I think we've covered pretty much everything that we've got on there. Touched on a couple other things, addressed a couple stocks from the chat, took a look at the top end of the scan. So we're probably going to cut the stream off for the week right there. If you joined us and stayed with it from beginning to end, or even if you joined halfway through and you're still with us right now. So I guess anyone who's still with us right now, thank you so much for tuning in on a week-to-week basis. We're going to be doing this again next week, and potentially again we'll do another midweek one if there's enough interest or enough activity or even enough, talking material based on what goes on in the market this week. So thank you so much for watching, and for the umpteenth week in a row, we are going to sign it off with our super corny. Thank you for watching. This has been the Hourglass Trader, where as time passes, we make money, and we will hopefully see you guys again next week. Thanks.